the southwest coast of England.
Oh, don't talk to me about the garden. I've a heron has been dining out in my pond and eating my fish.
What?
The missus caught it with a big one, took off from the garden, flew to the roof opposite and taunted me with it in its gob. So I've got to go out this afternoon and buy some netting. I haven't counted yet how many fish have gone, but yeah, not a good weekend on that front. I've got about 600 quid worth of fish in that pond, and it's going down. I need to put a stop loss on it and get some netting. But such is life, such is nature.
Did you leave the beast the name? Call him SVB also.
I called it a few things that I won't repeat on this channel. Yeah, have to sort that out. Let's crack on. Obviously, lots to talk about with all this banking stuff. But let's go back to what happened last week in the data. The NFP was obviously the key data we got last Friday, and it came in pretty strong in the end. Some expectations for whether some of the good numbers from January would wash out, whether there be revisions, so on and so forth. But it all came in pretty hot. Non-farm payrolls number up 311,000. Wages looking much better, 4.6%. Not as high as expected, 4.7%, but still up on last month's 4.4%. The only real downside was the unemployment rate ticking up 2 pips, but that's likely because, in part due to the participation rate, they're ticking up as well. So when you get the unemployment rate rising, even though there's strong jobs growth, we always look at to see what the participation rate does. That means more people have come into the jobs market looking for work, so classed as unemployed until they find work. So that's likely behind that. But overall, strong jobs numbers there. Canada, not too bad as well. Employment change beating expectations. The trend still in full-time employment. When you look at the revolving door between full-time and part-time going down, full-time going up. That's a trend that has been ongoing, which suggests that the jobs market is pretty strong over there. The unemployment rate staying at 5%. It was expected to tick up. Again, the participation rate staying unchanged. So likely why the unemployment rate has stayed unchanged as well. So we've got all that data, and the market still wasn't overly happy. We didn't see any meaningful jump in rate expectations, but because all this SVB stuff has been going on. So just in case you have been living under a rock this weekend, just a quick explainer of what's going on. SVP obviously got shuttered, and the authorities have had to step in, the Fed and the Treasury. The Fed have stepped in with a bank term funding program, the BTFP, because they love an acronym, which is offering loans of up to 1 year in length to banks, savings associations, credit unions, and other eligible depository institutions, pledging US treasuries and agency debt and MBS and other qualifying assets as collateral. They're ready to address any liquidity pressures that may arise, and the Treasury will backstop those emergency loans with 25 billions. The discount window for banks was opened and is available to provide ample liquidity. Senior Treasury officials said they will work with Congress and financial regulators to consider additional actions to further strengthen the financial system. They said that the FDIC's Deposit Insurance Fund has more than 100 billion. So this SVB blow up that has happened, the Fed or the FDIC put them to auction last night, and as last night, there hadn't been any bidders for them. There were queues going out the door for the UK arm. When I was sitting here last night, every 5 minutes another headline popped up with another bank interested in buying the UK arm. HSBC has won that with a bid of £1. They bought it for £1.
So wait. The ones who lost bid what? 50p?
Yeah. It's funny because when this is what happens in the UK. Even if something's, deeply in debt, a company goes bust and you have to buy it for an amount, and that amount is always £1. But obviously they're buying all the problems that have gone with it as well. And what they'll do is they'll get rid of the crap, asset strip it, fold it into the rest, and probably make a handsome profit on it, all for the sake of a quid. That's the way it works. But for now, we have to wait and see what happens with SVB, the US entity. I believe Germany is also doing the same thing as well, looking into that arm over there in Europe. And how that's going to unfold as well. So the Bank of England came out and said that the wider banking, or the wider UK banking system, remains safe, sound and well capitalised. And Chancellor Hunt said the UK banking system is extremely secure and funded. If that's not a headline that will shake you to your boots, I don't know what is. The Bundesbank decided to calm things down by calling out their crisis team to meet and analyse possible fallout. So they don't call it anything nice, like a, regulatory protection team. It's the crisis team, always going to instill you with confidence. Is that it? So Signature Bank has also gone to the wall last night. This is another one of the small regional banks, and a lot of these smaller banks have been highlighted as being in the tailwind from this SVB stuff, and banking stocks pre-market in the US have been hit very hard. So although the Fed stepped in and we saw a jump in risk last night, and when markets opened and early this morning, stocks rose, yields went back up, things looked to be better based on what the Fed and the Treasury had done, the market is sensing that all is still not well and they haven't done enough. People are still likely to want to take their money out of these smaller banks. Shareholders in particular, given that they're going to likely get zero, shareholders and bondholders are going to get zero out of any bank failures, are all bailing on their holdings as well. So it's a bit of a doom loop. Although the Fed and Treasury have stepped in to shore things up, at least protect depositors, they've done nothing to protect shareholders. And why would they? So that's created the next feed through loop, if you like, where now the shareholders and bondholders want to get out as much as possible in case other banks go bust and they end up with nothing. So it's all creating a bit of a snowball effect, and that's hitting risk again this morning. Bond yields, as you can see on the screen now, absolutely collapsing. Doesn't matter which ones you're looking at, it's a bloodbath across the yield space, as you can see there from all the different country yields. That in turn has hit Fed expectations. Remember, we were talking last week after Powell about the market looking for 50 pip hikes in March. Well, now there's some banks who are saying they're going to stay unchanged and not change the rates at all. Current probabilities are sitting, and if you remember, last week we started pricing, we were pricing 25s over 50s, then we were pricing 50s over 25s. Now we're pricing 25s and unchanged, at 54% for a 25 pip hike and 46% for leaving rates unchanged next week. Fed swaps also pricing in cuts for the year end again. Goldies no longer expect the Fed to deliver a rate hike at March. These are one of the ones who added extra hikes to their path moving forward. So let's bring the guys in. There's two ways of looking at this, really, isn't there? There is a chance the Fed don't hike, but I think it's more that'll be more over financial stability than inflation. Do you think? And do you think they will pause?
Well, that's a good question. The question we need to ask ourselves is: was the whole SVB calamity due to higher rates? A lot of people say that on Twitter and everywhere. Oh, these are the effects of the Fed. Well, if you look at the details, I've been reading a bit about it, and it seems like they just mismanaged everything. It's not. Yeah. It's not high rates that caused them to fail. Basically, they failed because they got about 50 billion worth of deposits getting taken out within a day. That was a problem. Yeah. But why was that problem? Why did that problem happen? Well, from what it seems, again, I'm I'm not an employee there, so I don't know. But from what it seems, they didn't hedge any of their interest rate exposure. And that for me is criminal for a bank. I mean, I used to market make swaps. All the banks were my clients, and the hedging was relentless. You have to hedge your interest rate risk. And if you don't, like apparently they didn't, if you own a ton of bonds, medium and long-term bonds, and the bond market is crashing, then your balance sheet starts to look pretty bad. And then probably that's why I'm guessing there was this big drive of companies getting their money out, the big run on them. But, if they didn't do any hedging, that's their problem. It's not the Fed's problem. It's not like if the Fed doesn't hike now, it was going to save them somehow. It was just bad risk management. Now, the question is can they or will they support the system by not hiking, by pausing for a while to prevent contagion? That's a question. And you're seeing other regional banks down 50-60% pre-market today. So there is a big risk of contagion. Let's not fool ourselves. But again, it's not the Fed's. The Fed didn't cause this, and higher rates didn't cause this. So theoretically, the Fed should keep going. But the question is, does the Fed let basically the market crash, and more regional banks fail? It's a good question. And unfortunately, I think the Fed and pretty much every central bank will always err on the side of caution and try to support the markets, because that's what they've been doing for the past 20-30 years.
So let me ask you a question then, because from what I can make out, there's several factors. Let's take, the first main factor is that they seemingly were over leveraged. 185 to 1 I'm seeing quoted around here, which is obviously huge. But let's talk about the hedging side and hedging their rate exposure. Okay, if they have all that billions of cash in deposits and they don't want to put it into risk, rather than just leave it as cash earning nothing, they can get half a pip putting it into, or between 0.5% and 1%, putting it into US Treasuries, not for investment purposes, but just to, rather than earn nothing, you can earn half a pip or 100 pips, just for the cash to sit there doing nothing. It's low risk because it's government bonds. You can't really hedge that because you're going to eat into that small yield you're going to make. Well, on the other side, they also had MBS securities which were earning 5%. So getting money on that.
Let me tell you, Ryan, the bid offer spread I was giving banks when I was quoting 1 year, 2 year, 3 year, 5 year swaps, half a basis point. That was a bid offer. So the hedging cost on an interest rate swap is almost zero for them. Yeah, because you think about, obviously, if you're earning 0.5%, which is 50 basis points, you will pay away half a basis point or a basis point. It's a percentage-wise, it's a big chunk of what you're making, but still, the cost of hedging is very, very low.
Yeah, no, I don't think it has anything to do with that, guys. Sorry. I mean, the thing is that they got stuck in what they call the hold to maturity bond market, and they had like 90% of their deposits and their balance sheet, or whatever you want to call it, in those hold to maturity bonds, which were paying clients a little bit. They were paying more than the big banks, because you have to attract money by paying up if you're a smaller bank. But then they got, like, if I read that well, somewhere 1.5% to 2%, or 1.75% return on the hold to maturity, and then only 10% of it was like available for sale, as they call it, where you can get out of bonds whenever you like. The thing is, with the hold to maturity, it's considered as one book. If you sell one single bond of it out, you have to revalue your whole book, and that's where the problem arises. They got stuck in this system of having too much hold to maturity, and that's where Stelios says they made a big mistake, which is actually literally, criminal is a big word, but yeah, for protecting your assets, that's the worst thing you can do if central banks start to rise. And central banks told them that they were going to rise. There's this one little phrase that resonates in my mind. Since he he said it last year or early last year or late 2021. There may be some pain taken. I mean, if you know that, then you react as a bondholder and as a bank. And in that case, in that side, it is actually criminal, because if you look at all those guys like Bill Ackman saying like, hey, we need a bailout here, they knew from mid 2022 that something was fishy, because already stocks were going down. What happens now is that because they have not reacted, and that's where I completely agree with Stelios, that is criminal. And it's not because of the central bank raising rates, it's because them not reacting to the situation. That is, it's yeah, it's if you run a bank, you should have at least knowledge of how to run your deposit versus bonds book before starting. And then they are how should I say, all those venture capitalists and whatever activists who have been in the markets for a long time, so-called consulting them and telling them what to do. Well, they're all like fucking criminals themselves. I mean, they just look for 100% return in a startup. The startups are in a way, because they have running costs and things like that. They are the victims in this, but all the others, the bank and all those venture capitalists and whatever, who have all the knowledge in the markets, they have been really badly advising these banks. So I know a lot of people. I'm going to run against a lot of people, but this is not a bad job from the central banks. This is a bad safe and sound running of bank assets and liabilities.
Yeah, no, I agree with that entirely. And as I say, one of the big problems was their leverage. But what they did do, they were going to realise their loss.
No, I don't think it's sorry to hold you back, but it's not leverage. If you look at the amount of deposits versus the amount of bond holdings, it is a result of people wanting to take out their money because they have running costs, but they are not over leveraged, but they've been stuck in too much of those hold to maturity bonds. I don't think it's a question of leverage. It's a question of you're stuck in something, and then you lack liquidity when people need money, and that is the thing. But I mean, you can call it before the global financial crisis, it was called leverage. Now it's called a lack of sound handling of the business. And of course, one thing where perhaps the regulator can be called into fault is that they, after the global financial crisis, they stopped those emergency rulings, barring from the systemic important banks. The other banks were not did not have to respect such a strict rule as the global big banks, and that's where the regulator is at fault. but it's really a mishandling of they didn't understand what the market was doing. That's as simple as that.
Yeah, no, I get that. I'm just telling you what people are saying, that it's that the amount of bonds they had versus deposits was highly leveraged. But anyway, moot point either way. So so another point is, okay, they should have known that the Fed were going to hike in rates, but is this still a question of the Fed hiking too far, too fast, and now these problems are coming out the woodwork, do you think?
Yeah, go ahead.
No, I was going to say there's always going to be an effect from the fast hiking and the fast tightening, but again, this is not something driven by that, in my opinion. No, it's but now we're getting to the point where there's going to be contagion. I mean, it looks like it. So do tighter monetary conditions help? Of course not. Will looser monetary conditions help? In terms of psychology, yes. I don't know. It's a really tough one, and I'm looking at this chart that you have of the 1 year U.S. notes. man, these are just on the verge of breaking down. And it's been a massive move, massive weekly move. But anyway, sorry, not weekly, a couple of sessions basically.
A couple of hours.
I really don't know what's going to happen next. I really don't. I don't know if you guys have an idea, but I am stumped. I don't know what to do with this.
Yeah, well, I think we can safely say the 50 is off the table. That is completely off the table. They will not hike 50 after this episode. Now, I think perhaps tomorrow CPI will tell us if they do 25 or go to zero, and the rest is contagion. Is it contained or will it continue? And that is only something that that people really involved in market, deeply involved in markets will know. But yeah, it was panic stations on Friday in the States, and it's panic stations this morning. If you look at the repricing of the European and UK and whatever yields and curve, it's actually pretty heavy. And I don't know if any of if we have so many regional banks here in the European continent as a whole, UK included, that it's all of a sudden a systemic problem. The thing is, as we have been already mentioning many times, it's all one deal. So if something cracks in this one deal, and we always said it's all about yields, how far they will go, and how restrictive the liquidity stuff is. And it's all one deal. Now there's a crack in there, and yeah, the crack shows up, and only the guys in the knowledge with the funds to manage, or the big banks will know when this is over. I think the max we can expect next week is 25. Could it be zero? Yes, if we get a low CPI, lower than expected, if in the meantime the whole situation is not completely calming down, which I think on that side, I think there should be enough liquidity and those how did you call it, Ryan, the bank funding program?
The backstops.
Yeah, backstops the depositors. I think that on that side things should quiet down at least. Now the rest, yeah, I think is over to the CPI, but I really think there should be some sort of official statement coming out, again, another one saying, and it's most of the time not helping, but it quiets just down the markets just a little bit, saying that this is X% of the market. I mean, don't go all ballistic over it. Because, I mean, those failures, yeah, I mean, after the GFC, the banks have been backstopped, the more rules have been put in place, and I think the system is not going to. We are not in a situation where the system goes down or more down than the panic that we are seeing now. That's just my 2 cents, of course.
By the way, you guys mentioned. Sorry to interrupt. You guys mentioned CPI. Did you know the statement that Biden made on Friday, where he said that I'm sure that the CPI or inflation is heading in the right direction, something very positive about inflation dropping. Do you think he would say that if he didn't know the number already? And risk looking like a fool this week. I think he knows. I think they have the number, and the number is going to be low. But just my 2 cents. I'm a conspiracy theorist, right?
No, I get it. It was very strange, the comment he said about that as well. But coming back to this, I mean, I'm of the same mind. This is not Lehman's. This is not 2012. The Fed and the Treasury were fast to act last night, shore up deposits, make sure people who needed to get their money back would be getting their money back, and the same for the other bank, and putting in place these backstops for deposits. And what we're seeing here, yes, it's contagion. It's not contagion in terms of the banking sector going under. It's contagion in terms of people likely to be taking their money out of regional banks, shareholders offloading shares in and bonds in regional banks because of this risk. And then I think it's it's probably going to take today and maybe a few days for it to all wash out, and then perhaps we settle down some. Obviously, never say never when you talk about these things, but there is going to be a lot of volatility coming in for the next couple of days. Biden is expected to speak this morning, I think, make a statement on this banking stuff. We should also probably expect that perhaps the Fed or the Treasury pop up as well to calm markets again. You know, probably looking at over the next hour or two, something along those lines. And I would expect it to be that the financial system and banking system remains solid in the US. That'll be their message. But yeah, there's maybe some problems, and they'll be dealt with accordingly. And that shareholders and bondholders may get zilch, but depositors up to a certain level will get their money back. And you know, I think we saw an idea of what would happen if things were sorted, or if the market liked the noises the officials made. And we saw, you know, stocks opened up down, but they bounced quickly after, if we look at that last night. So coming in, we opened up, you know, quite well down, and then we bounced quite strongly. Back up into the 39s. You know, here he is here. Now we've seen the move back down towards the lows, and you've got to keep an eye on those numbers there to see if we break those lows. The same was happening in FX. I mean, you look at something like dollar MEX. You know, I was trading this one in and out off the 1850s. I actually managed to get a good chunk of them away in this move down 1830s, and now look at it, it's sailing up near 19s. You know, huge moves this morning coming on.
Unwind of carry trades there for sure, right? Some.
Oh yeah, that's exactly what I said this morning in the room as well, and on Friday as well. I think this is unwind of carry trades, because if you look at stuff like Euro white MEX crosses, they have like exploded. But
Yeah.
then again, this could in theory give us like pretty decent levels once the situation quiets down, to get into it again. I'm really watching. Euromex is above 20, and there's some interesting levels coming up. I won't do it now because we still have the States to come in, and I'll probably wait until after CPI. But there could be some quite juicy levels coming up.
Yeah. So, you know, there's two ways to go with it. You can either go with the fear that's in the market now, so trend the way the fear is trending. Now may not be the time to start countering that fear trade, because obviously you look at the move there where it's gone from near 1820s to near 19s on something like this, and you look at what yields have done. These are not moves you want to be standing in front of at the moment. I'm certainly not. I'm long some S&Ps. I'm out on dollar MEX. I'm in small S&P, so I'm not going to be pushing a boat out on anything. I'm not inclined to start jumping in front of trains and anything just yet, because we're yet to see what the full reaction is from the US when markets fully open and we get the cash open. So really, the exercise is just to protect your account at the moment. If you've made money on this, if you've been in the right side of these positions, don't look that gift horse in the mouth. Take some money off the table. Get your risk down, because there is a lot of volatility in the market here. And, you know, one headline and this all reverses again. 1 year yields could be back above 5% in the blink of an eye. What I think it's done for the longer term, and you know, agreeing with the guys here, I think it's taken 50 pips off the table from the Fed. The market is scaling down its rate expectations across the board for other central banks as well. I think it potentially also maybe puts a ceiling on the Fed stuff. Maybe we don't get the market or get the Fed heads moving their ceiling as high. Maybe this has shaken them in thinking we still don't know the full effect of rate hikes. There may be other skeletons waiting to pop out of other closets to do with rate hikes. So maybe this will be a nudge to get them thinking a bit more cautiously about further rate hikes, maybe taking a slower and steadier pace rather than the more speedier pace than Powell even insinuated last week. So lots of things to bear in mind. You know, we all look at the techs. But in these volatile situations, I can tell you the techs very rarely count for much. Okay, you don't trust them. I don't trust them. I'm not going to be trading off, hourly fibs or hourly moving averages when the price can jump 60, 70, 80 pips in seconds. If you want to trade and use your techs, then really look to the bigger levels. K's bolted onto the 139s. I think 133s in dollar yen. This was an area, as we know, on the way up, held for quite some time before we got a big break. I think K's leaning on this. The cloud's coming in here somewhere, isn't it, K? Was it 130?
Yeah, as well, yeah, 133.55 today.
55. So
yeah, there's a bit of stuff between 132 and 132.5 and 133.5 on the wide. 132, 55.65 or 55.70. That's where somewhere I see a decent level as well. So yeah, but again, I mean, in these sorts of markets, I have nowhere near full positions on. So because just of the speed of it, you can make with a half a position or third of a position, you can make as or lose as much than with a full position in quieter markets. So yeah, I'm keeping things very well under control right now.
Yeah, exactly. You gotta keep things light, gotta keep things tight. If you're gonna fight the trends, don't let yourself get offside massively in them. As mentioned, this area 133, old fib, old area 132.90 area, and it's held and a decent bounce. But another headline and this could be 132s. Another headline, it could be 135s. You just don't know. So just be careful with what you're trading. I don't trust the techs as much right now. I'm going to be looking at the headlines and seeing what comes of it. Kay, do you want to have a quick look round?
Yeah, sure, buddy. Sure. What are we going to look at today? I think actually the less interesting today would be stuff like euro dollar and things. Although we are into the ECB, so that should come into play. For the time being, we saw this. Let me put it on the lower time frame. So this is the SVB move, really. A bit of NFPs, but I think what happened after the NFPs on Friday is just a continuation of what of the SVB and other situation. There was a little lower in the working hours, I think, and the unemployment rate ticked up slightly, but not enough to really create this move. So everything is still down to those regional bank moves. So on Friday, we stopped around this 107 again. I think we just tagged 107 on Friday. This morning, we moved through it, and now we are rejecting it already. Why? Because of this. If you want to look for correlations or contagion, you just, as Ryan already said, just look at what European yields, UK yields, whatever yields have been doing. Even and that was like the biggest one of all. I mean, look at the Japanese 10-year yield. Look at this. We're hammering around this 50, around the limit of the yield curve control level, and it's dropped. The Japanese 10-year has dropped 20 bps. So it's a global repricing of whatever the people think that should happen. And the markets are just so jittery that they are just they don't know what to do. So it's a constant nervous repricing of everything. And I have to say, Arif on the Q&A says a couple of things, and in the chat that I fully agree with is that. A lot of those bankers that we have now, since the regulator got hold of the speculative side and the proprietary side of banks, they have taken away a lot of market-making liquidity, and the new bankers, and I agree there with Arif, are more salespeople than there's much more salespeople in a bank than traders actually. But I mean the thing is completely reversed. I remember when I was in the 90s in the Barclays London office, we had like nearly 40 traders, 40 spot traders. And we had a couple of rows of sales sitting around us. My last employer, I think, and in Barclays London, that was only in the London office, in the head office, right? So my last employer, which is also a top 10 global bank, they are now globally around the globe. So voice market traders who normally add liquidity together with hedge funds and whatever. We did add liquidity because we were allowed to have positions in the past. And now, due to all of it, I'm not saying only due to regulations, but a lot is due to electronification as well. I think they have like 7 or I think 8 or so globally around the globe voice traders. So I mean the numbers have just been but they still have the same number of salespeople, and that's the thing. So there's a lot of just market making liquidity that's gone out of the markets over the past, call it 10-15 years, and I think that is also a bit responsible for what those moves that we see here, because they're getting a little bit out of control, because it's either run out of with junior people or run out of panic, or it's just machines. And machines, they don't give a toss whether the US 10s is at 390 or 4%. Somebody overloads them or puts them short bonds in their electronic machine. They have to buy, because they are no real market maker anymore. They have their like limits and stuff, and then they just have to buy, and they will buy at any price. They will not think about having what should we do here? Is it out of context or out of zip with the market? No, they have to buy, so they buy. That a little bit on an aside of how market liquidity has changed. So yeah, this is a pretty violent repricing, right? And it's across the curve. We've just if you look at it in theory, if you look at the 2 years, we've just priced out 75 BPs of hikes over the course of 3 sessions, which is I've rarely seen this, apart from in really crises. There were some talks about people, and they were saying like, this is 1987, and be careful for the stock markets, because they could be the next ones absolutely pummeling. So we are not comparing this to the global financial crisis, and I don't think we should. But some people say like, okay, this could be like the 1987, and that lasted 3, 4, 5 really aggressive days, which could be these, and then gradually started to stabilize. As it also reminds me of the 1998 Asian financial crisis, where dollar yen famously dropped 20 big figures in 36 hours. That it has those looks if you look at the yields. Speaking about dollar yen, let me go on the daily first. Clouds. You know, we know that Japanese accounts are watching these, right? Today, the top of the daily cloud, 133.55, and we are not really far away from this. And then just below there, as I was, there was this, the last run-up, really, that, well, no, this one may not be the right one. But anyway, this if you look at it from the lows to the highs, 133.16. 133.16 here is the 50%. And then if we go on a lower time frame, I'm seeing this, the fall from 138 down, and we went like nearly back up there. There's a bit of a level here as well, 132.70. And then there's the 50% of the move back up from 127 up to close to 138 is 132.58. So that's why I'm saying this zone is to me, we have to watch it if this holds, first of all, and then at the end of the day, we have to watch the daily cloud, I think 133.55, where if we close above or below, Japanese accounts may be tempted to trade it on the back of it if when they come in overnight, the next night. So that for the dollar yen. Canada, but I really don't know about what's going on the dollar cat. To be honest, I have not been involved. We had broken below this 137.60, then went into what is supposed to be another bit of a. This is the 23.6 of the last move higher, is around 137.20. We had a look below. There's a bit of activity as well in the high 136s, in my opinion, up to this 137. The prior high 137.05. So the low 137s should be pretty important for this pair. In the meantime, we're already back above, so I think the levels have shown up. Globally, what I think about the Canadian, but we have to be a bit careful now with the volatility, right? But I think the fact that Bank of Canada was so cautious on their past comments and leaving the rates unchanged, we have to look at crude, how that will behave as well. So there's a few things that we need to take into account. But fact is, and this trend line is perhaps a bit fresh and seen the current circumstances. Perhaps not that good, but if we get back into this 146.5 to 146.28.30, this is those big bottom top triple top here. This Euro Canada is probably going to be an interesting one to watch. I think especially into the ECB later on. Assuming that the rest of those yields are quieting down, I think if we hold this level, and I'm going to include, because that's probably, you see the 146.30 is there again. I think this is going to be the thing now. 146.25 holds or gives way. This is the level that I'm looking at right now, and for the time being, I'm still positively biased on this one. I think we could see it a little bit higher, and then after the ECB, we will decide what to do with this. Yeah, we could talk about 100 pairs today, but on the Aussie, for instance, people were watching the 60. What was it? 66. Something, and I heard people talk about the 66.70, 66, 65.70. It's also the 200 on the 1 hour, but I'm not a fan of those ones. But yeah, it's kept below the prior highs, so I think Aussie is still a bit. We still have to be a bit cautious with long Aussie positions for as long as we hold below those levels. There's this one coming in, but that's higher, right? That's above 67, but then already 66.65 up to 66.90, 90.95. That's going to be your first resistance area there. Right, what have we got going on here? This is your unwind in dollar mex. It's fierce. It's really going hard, but that's EM risk off for you right there. And when the market feels that it needs to get out of positions, it's just going to get out of it. And EM and emerging markets having so much less liquidity than the main pairs. This is really it, right? We have done what is it, 5% now from the lows. There's a bit of interest here in the high 18s, but and it could be all over, right? Because we have seen Mondays set in extremes, and then the rest of the week it starts to calm down. We might have seen it, but I would allow, though, if there's more stress in the system, to go up into the 1910.25, and there's really going to be, this is the last spike early February, and I think there it's going to be interesting to see what's happening. If that goes through, then we're talking about 20 again, in my opinion. But in my personal view, I think I'm going to be looking for levels to start shyly to get in to mix pairs again. And on the Euro mix, we may see a break above 2035, perhaps, and then go and have a look into these again early February levels, 2067. But that, I think, to me at least, is going to be an area to really look for re-entries into the mix. I don't think Mexico Central Bank is ready to start to cut rates right here and now. Dollar rand again, holding, and I didn't trade it today, although I had an eye on it when it was around, well, a little higher, but around the lows. Again, we're holding the low 18s. So for the time being, this, I think, is still positively oriented. If we start to go below 1805, confirm it's up 1795.99. This could be in for a deeper correction, but for as long as it holds, it holds. And on the dollar China, I think it's 684.85 here. 684.86 is the support area. Prior low, which was also a little bit of a shock low, held again around 686. So and 690. Oops, the first one here, 693 on the top side. So that's your initial range to watch if you want to trade CNH on at the start of the week. I think that's a pretty interesting range to watch, and I think I might try to trade the range actually for a little while if it allows. And if it looks like two boxes, right? You have like the 685, 80, 693 box, and then the 693 to call it seven box. Yeah, you have like two little boxes here, and they could direct the affairs right now. Ryan, with this, I give it back to you, mate.
Thank you very much, mate. What we'll have a quick look at is, let me share my screen if it allows me. Can you see that okay, guys?
Nope.
Same problem again.
Yeah. So what do you want to look at?
If you let go of the screen, you can't take it back. That's so weird.
Can't take it back. That's what's going on there. No, I was just going to look at the calendar for this week. There's not too much, as is the case after the non-farm payrolls. I'll just have to read it out. Obviously, we've got the ECB on Thursday, probably the biggest item. US CPI tomorrow. It's also the start of manufacturing for the new month. So we get the Empire State on Wednesday, F.A.C.E manufacturing on Thursday. And then
I'm sharing the screen, Ryan.
Yeah, I use my big calendar view one. So
okay, what do you have? So tomorrow CPI.
Tomorrow CPI. Wednesday there's some China data, industrial production and retail sales. Then we get US retail sales, Empire manufacturing on Wednesday. Thursday is obviously ECB day, and we get the F.A.C.E manufacturing as well. Friday, Eurozone CPI and the Michigan consumer sentiment numbers, with those all-important inflation expectation numbers, which will be closely watched going into the Fed the following week. And just on Thursday, we've got Aussie jobs report, which can be a bit of a mover for the Aussie dollar. So keep an eye on that one. So that's our week. This week, and plenty of fun and games, no doubt. What's going to happen today? As I said, do stay safe with your trading. If you're not sure, reduce your risk. Don't trust your levels as much as you would normally. Don't go offside too far and be wondering what you should do next. Please trade safe. Let the volatility die down if you must, and then come back in and pick up the pieces thereafter. Lots to listen out for on the headline front today. Bidden, regulators, central banks, whoever, they'll all be piping up given their chapter and verse, and the market will react. So please trade safe. Please have a good one. Make lots of pips. Thank you as always to Kay and Stel, and we shall catch you up tomorrow. Thank you very much.
Thanks and good luck, everybody.
And Catherine, I hope your lawn gets sorted as well. I saw your message earlier about the birds ripping it up. So good luck with that. Thanks all.